everybody to our July webinar on listed private equity. Today I would like to present findings of a new study. But before I do that, I would like to give you a short introduction into listed private equity and the LPX 50, because this is the basis of the study that I would like to show you. So I would like to be sure that everybody has the same understanding about the basis for the study and the underlying data. So what is listed private equity? Listed private equity are companies that are traded on a stock exchange and are doing private equity business. That can be either that they invest directly from their own balance sheet into unquoted companies. That can be that they invest into private equity funds. So in this case, we talk about a fund of fund structure. Or it could be that we have a company like Blackstone that is acting like a private equity asset manager and is generating fee income from managing private equity funds. So all three groups of companies are part of our universe. We analyze the direct investing companies, the fund of funds, and the asset managers. And we then construct various indices based on that base universe. Very important to mention here is that we only include private equity companies that also follow an exit strategy. So for us, it is very important that the companies themselves also sell the investments they do. So a pure holding company would not qualify to be included in our universe. Summarizing here some of the main organizational forms that we see in private equity in general. So when you think about a limited partnership structure, an LP-GP structure, we have a closed-end fund where you have a GP that is managing that fund. That can be a Blackstone, that can be a KKR, which are themselves listed. In listed private equity, we have, as I mentioned, those three groups. When we focus on the first two groups, the fund of funds and the direct investing companies, it can be the case that they have also a general partner that's managing those investments, but it can also be the case that those investments are internally managed, so that you have the management team on the organizational structure of that listed entity that is then managing the investments, either fund investments or direct investments. There are some other variances of that, but in general we can say that we have those two type of structures in listed private equity companies, and for unlisted private equity investments we still have the LP-GP structure. In the meantime, we have those evergreen funds, so we have new fund types emerging, but in general I think this is pretty much summarizing the main organizational structures that we see in private equity and listed private equity. Now let's come back to our indices, and the question is, how do we construct and design our indices? We start with a base universe of around 300 stocks that are actively making private equity investments. However, I must say at this point that part of those 300 stocks are very illiquid and very tiny companies where it simply doesn't make sense to make any research or to include them in an index. So we focus on 120 stocks that are liquid and large enough to make a liquidity analysis and then construct an index based on that universe. When we do the liquidity analysis, we focus on the stock market liquidity. So we look at the bid-ask spread, at the trading volume at the stock exchange, at the free float factor, and so on. And then, for example, for the LPX 50, which is the basis for the academic study, we take the 50 largest listed private equity companies and weight them according to the market cap, and then do also rebalancing twice per year. In addition to the market price index, which is reflecting the stock market performance and can be compared to any other stock market index, we also track the underlying NAVs, the book values of those listed private equity companies. And basis for this are reported NAVs from the companies. However, they are also checked by us and are also adjusted in case we think the NAV is not representative. So we would like to make sure that we have a representative NAV index and an NAV number for each company in the index to make it comparable and also to use it as a benchmark to measure the underlying book value or NAV performance. Then when you compare the market price and the book value or the NAV, the market price can either be above the net asset value, then in this case we have a premium, or it can be below the net asset value, in this case we have a discount. So this discount is reflecting what the market thinks currently the NAV is worth compared to the net asset value. And we update all three indices on a daily basis. And the indices are available on various data vendors like Bloomberg, Refinitiv, FactSet, and so on, but can also be downloaded directly from us. And here we see the stock market index of the LPX 50, so measuring the stock price performance of the largest listed private equity stocks compared here to a global stock market index. And as you can see, we have a very strong outperformance over the past 15 years, a slightly higher volatility compared to traditional stocks. But I think this shouldn't be a surprise because we're talking about a very risky asset class. Private equity in general is a risky asset class, and this is also reflected by the numbers that we see here. Now comparing the stock price index, the total return index, with the net asset value index, and here you can see by nature net asset value has a much less or is much less volatile compared to the total return index. And the blue line here reflecting the net asset value index is measuring the underlying investment portfolio performance as measured by the net asset value of the companies included in the LPX 50 index. Then comparing those two indices gives us the premium discount index. As you can see here, we currently have a discount of around 18%, though the market is still trading. Has been the case over the past almost 15 years. After the financial crisis, we mainly saw discounts, with the exception of 2016-17, we had almost reached a premium, and also in 21 we had reached a premium. Before the financial crisis, we had premiums of up to 20% on average, but currently trading at an, in my opinion, attractive discount level. And again, this data is updated on a daily basis, so every investor can see what the market thinks the valuation is of that investment portfolio, and can be used in like any other time series data that you are used to from when you do stock market analysis. We would like to make sure that every user of the index data can use it in the same way as they are used to it from other equity data. Now I would like to come to that study that was recently published, portfolio management. The question here was, is it possible to predict returns of listed private equity based on a very simple analysis that we have done a couple of years ago, where we simply checked whether time periods where we observe a very high discount are followed by an outperformance of private equity over traditional stocks. So a very simple analysis, but that was the starting point, because here we saw whenever there was a very high discount in the market, we observed an outperformance of private equity over the following years. So this is not an academic study. This was just an observation that we made, but this was basically the motivation to take a deep dive into the data and check whether we find any statistically significant information in our data set. And as I mentioned, this has recently been published, so feel free to either download the paper, or in case you don't have access to the journal, I can also forward you the paper. But here you see the link, and it, as mentioned, has just been published. And now let's go to the analysis and have a deep look into the data and what we have analyzed here. As mentioned, we use the LPX 50 index, which contains the 50 largest listed private equity companies. We have the stock price index, we have the NAV index, and we have the premium discount index. The sample period covers 2005 until 2023. So almost 18 years of data, so that we are also able to capture various market cycles and macro conditions. It's a very diversified portfolio over various investment regions. It is mainly buyout deals, so the underlying investments are mainly buyout investments. And when we have a look at the vintage year distribution and the sector distribution, you also see that we have a very diversified portfolio of investments over the past years, and also over various sectors, as mentioned, measured by the GICS sector codes. So, and important here to mention is this is relating to the investment portfolio. So this is a look through the companies themselves. And this is basically the work that we are doing at LPX to analyze where do the listed private equity companies invest in, when did they invest, in which sector did they invest, what is the valuation, and that is then the basis also for this distribution chart, and is quite representative for the private equity asset class in general. Now here you see a more sophisticated version of the initial chart that I showed you. So we have here in blue the NAV-to-price ratio, and then associated with that we have the 24 or 2 years returns. So when you observe an NAV-to-price ratio in 2004 or in 2010, you can simply see what is the following 2 years performance of when we observe that kind of premium or discount in the market. And before we did our analysis, we did a very standard analysis, risk factor analysis using the Farmer-French model, because we wanted to know how we can explain the returns from that kind of perspective, because we think that's a standard model that you should do whenever you do some return analysis. And as you can see here, we have a market factor of 1.34, so higher beta to the market, or beta of more than 1 to the general stock market, with a size factor of 0.27, which is significant at the 5% level. This indicates that the index is exposed to smaller size companies. And we have a value factor of 0.44. That is even more significant at the 1% level. And this indicates that we have exposure to companies with a high book to market ratio. So, but from my perspective, the most interesting figure is what we see on the next slide, the CMA factor, which is negative and is also significant at the 1% level. And why is this a very important figure from my perspective? Because this means from a French model that there is an exposure to growth-oriented firms. And this shouldn't be a surprise, because private equity by definition is grow companies, to make investments into small companies, into companies that would like to grow internationally, that would like to enter new markets. They need a network behind them to help them to grow. So that's basically the DNA of private equity, is to help companies to grow. And it's interesting to see that from this point of view, we see that the data tells us, yes, the index is a growth-oriented index, and this is exactly what we would expect from a private equity investment strategy. We also have a very high R-square, so we can assume that the model already explains these historical returns very well. So that is already a good start from that kind of perspective. So the initial findings is we have an exposure to smaller value stocks. We have an exposure to growth area-oriented stocks, and this is exactly what we would expect from a private equity portfolio. We also had a look at the autocorrelation and find significant autocorrelation, which already suggests that there is an inefficient market maybe, and there should be some predictability for future returns just based on this initial autocorrelation test. So this is basically the basis. You have now seen how we define listed private equity. You have now seen how we define the LPX50 index, which is the basis for this study. We have 3 types of indices that are used for this type of analysis. We had done some very preliminarily standard methodologies that already show that there is something to find here, and also shows that we are talking about growth-oriented companies. So I think the setup is very promising. And now what we did here is we really wanted to know whether there is some predictive power when looking at the NAV-to-price ratio. You see here the results of that analysis, and what was done is that we have looked at various return horizons. Looked at 1 month, 3 months, 6 months, 1 year, and 2 years horizons. And as you can see here, the R-square for the out-of-sample test increases. So the effect increases by the return horizon. So the longer the investment or return period, the more or the higher the effect. And also the significance increases from no significance for 1 and 3 months, but only with 6-month returns we have a significant level of 5%, and 12 and 24 months we have a significance level of 1%, which shows that there is something here, that there is some predictive power when using or when analyzing the premiums or discounts, and that we can expect an outperformance when focusing on companies that trade at a discount. So this is already a very interesting result. This shouldn't also be a surprise that the longer the return horizon or the longer the investment horizon, the better the results are. I mean, that should, or is something that I had expected, because the longer the return period or the longer the investment period, the more likely it is that the stock price follows the underlying fundamental value. But we wanted to know what happens if we exclude a very extreme time period, like, for example, the COVID-19 crisis, whether this changes the results or not. And we have the results here on the next slide. Interestingly, as you can already see, it does not change the result. It is even better. So you already here you see we have a significance level for 3 months already. So when we go back 1 slide, we didn't have that significance level at 3 months, and it's at 1% level. We have it also for 6 months, 1 year, and 2 years. And for 2 years, the effect almost is 5 times as high as for the full period. And also at a very significant level. So this means that we have, especially during times when there are no extreme phases like COVID-19, we have even better results. But even including extreme phases like COVID-19 or the financial crisis, we have this predictive power in the premiums or discounts. And the R-square even is higher when excluding the COVID-19 crisis. Here we have for the 2 years period, we have the 0.31, and for the full period we have 0.27. So this is, I think, a very interesting result, and all the details are mentioned in the paper. I'm only mentioning here the most important points, but the question now is, why does it work at all? And there were several reasons for that. I mean, I cannot mention all of them here, but the main reasons why it could work is that macro news can push the prices from the NAV. There's sentiment in the market, there's liquidity constraints. And I think very important point is that there's a very limited analyst coverage. I mean, for the blue chips in that sector, for the large companies in that sector, we have analyst coverage, but for the small and tiny ones, there is almost no analyst covering those companies. So I think that's also one of the reasons why we have still this inefficiency in the market. There's also a time lag between the published NAVs. So this might also be a reason, but in general, we can say, yes, an investment strategy could be based on that type of information. And yeah, as I mentioned at the beginning, we already saw this over the past years, that we always see an outperformance of private equity over traditional markets, especially when we have very high discounts in the market. So yes, we can exploit that inefficiency. It's also a very robust predictor of listed private equity returns. Of course, we would like to do some more research on that, maybe look at some sectors, do some more macro factor integration into the analysis. But in general, this is already a very interesting results for everybody that would like to do some investments in this space. There are some limitations that I would like to mention here. I mean, one of the limitations is that there is a lag in the NAV, so it's very important. This is what we do at LPX, to get the latest information which is available, and that is not necessarily the latest report, be it a quarterly report or an annual report. That can also be information which is publicly available, but is not, it's not seen by the market, but that is any information published by the companies regarding the investment portfolio. That can be a trade sale, that can be a revaluation. In many cases, that is published even before the next quarterly or annual report of the companies. Another limitation is the liquidity. I mean, we have liquidity criteria for companies to be included in the index. However, for those companies that are not part of the index, there might be a liquidity constraint. So an investment strategy based on those criteria is limited in size, in the meaning that it's not possible to have an unlimited amount invested into that kind of strategy, because we are talking in some cases of illiquid and small stocks, especially when you look at companies that are not part of the index. So this is important to have that in mind when looking at this type of companies. However, investment implication is straightforward. Screen the stocks, screen the companies, look whether you find some undervalued companies. Then, of course, it's important to mention that it's that there might be a reason why there is a discount, and a reason that is maybe justified by the investment portfolio or justified maybe by the quality of the NAV being reported. So it's important to have a look on that also on a case-by-case basis. But then, implement an investment strategy based on that findings, I think is straightforward for anybody who is active in the equity investment space. So that's it from my side for today. Here you have a QR code where you can access our latest barometer, subscribe to the barometer. And if you have any questions, feel free to reach out to me directly via LinkedIn or drop me an email. Otherwise, I look forward to our next webinar in autumn. Thank you very much.